All right, hello traders. I'm very proud to welcome everyone to the NinjaTrader Ecosystem Trade Like a Pro webinar series. I'm your host for today, Wesley Sinks, Business Development Team Member for NinjaTrader Ecosystem. Before we get started today, I wanted to do just a quick test of picture and sound, so if you could, please just type a Y in the room. Let me know you can hear my voice and see the projection on screen. All right, a lot of yeses coming through. Thank you so much. And also, before we get started, it's important to understand there are substantial risks in trading commodity futures contracts. You should carefully consider whether such trading is suitable for you, and that will depend on your specific circumstance and financial resources. It is possible to lose all funds deposited with your broker, and you could even incur losses beyond these amounts. Please inquire at brokerage support at ninjatrader.com for more information or for a copy of the CFTC full risk disclosure. Also, please remember that these ecosystem webinars are not a solicitation or recommendation, but simply educational in nature. All right, today we have DB Vial of Order Flow Analytics in the room. DB is going to discuss why trading on price action alone and ignoring volume is a big mistake. He's also going to be covering the 7 steps you can take to become a more successful trader. So whether you've heard of DB or you're new to the methods of order flow analytics, the style of trading, you're definitely in for a very exciting event today. So without further ado, let me welcome to the room here DB Vial of Order Flow Analytics for this very special Trade Like a Pro event. Go ahead, take it away, DB.
Wesley, thank you. I appreciate the introduction and the opportunity. Good afternoon, everyone. Everybody doing okay today? I want to thank you for joining us today. I'm down in Texas, and it's Cinco de Mayo, so hopefully there's a cold Corona waiting for you somewhere. If not, maybe you were celebrating yesterday. My children told me it was Star Wars Day. I'm not sure I'm in the right zone for that, but I'm going to celebrate Cinco de Mayo. Today, I'm going to be talking about some unconventional ways to get a little bit more from your charts. If you happen to see the interview that I did with John or the promo video we did for the event, you probably have an idea what I'm talking about. And if not, that's okay. We're going to jump right in and get started. I actually want to throw up a quick poll. Remember where it is. Instant poll. And start. And essentially, I just want you to answer if you can. When you open up a chart, what's your kind of default go-to style of charts? Are you a bar chart person, a candlestick person, line chart, alternative like point and figure, line break, something like that? Wow, we have some people participating today. I like this crowd already. Excellent, excellent. Okay, well, I assume you guys can see the results. I don't know if you can or not, but basically it's about 70, bouncing between 70 and 75% to the candlestick side. Generally speaking, that's the case. Anytime I ask that, people basically tell me the same thing. Why do you think that is? Why do so many people like candlestick charts? Anybody have an answer? Simple, easier to see. Generally, I know you guys have to type an answer, so it's a little harder than me just talking along with you. But generally, what people tell me when they have the opportunity is that it allows them to see the sentiment, right? You kind of get this sense of I'm seeing the sentiment as opposed to just some line on a chart, and I get that. So let's start with sentiment and this idea that we can actually see it in the chart, and we'll go from there. So here's a candle. It's formed by the open, high, low, and close, and that's all in some given time series, and we can argue about what a time series is at a different point in time. The candle body is made up of all the prices between the open and close, and in this case, the close is higher than the open. So we would assume this to be bullish or bearish. Anyone? 75% candlestick people in here. Is this a bullish or a bearish candle? Bullish. Very good. Yeah. Okay, so price moved up and it closed higher. So a candlestick person would say that this is a bullish candle. But honestly, without more context, it's probably not fair to make that claim. So let's add a few more candles and see if we can get a little better picture here. Right? So now we can see that the price was in a decline And the big green candle, well, it really does look bullish, doesn't it? Right, this is what a candle chart analyst would call a bullish engulfing pattern, meaning if we looked at the open and the close of the big green candle, essentially all of the bodies, the opens and closes of all the other periods are engulfed or eaten up in the single move up and across the prior move lower. Okay, well, let's look at a couple examples of this type of bullish sentiment side by side. On the left, we have the E-mini S&P chart that we were just looking at. And on the right, I've added a chart of gold futures from April 27th. So both of these have the characteristics of bullish engulfing patterns. Okay, the open and close of each more or less swallows up the previous bodies. Now, there's some subtle differences. The ES has a more defined move lower. The gold chart appears to be a little more indecisive prior to the breakout. Does either one of them appear more bullish than the other? I mean, I realize these are small segments of a chart, but if all things were equal, given the data that we have right here, does one stand out as a better setup? Well, I can't tell the difference, so let's just see what happens. The ES trade backs down and it forms a range, while the gold trade breaks out and rallies higher. Why? I don't know. Both of them had massive momentum and closed higher. Both of them gapped back down and opened below the higher close. Well, I can't pretend to know what happened in these markets to make one work and one fail, but I can tell you that there's a lot more information here to support a trading decision than what we're looking at. And I'll even go as far as to state publicly that candlesticks are obsolete. So are bar charts and line charts and any other financial chart out there that's limited by these data points: the open, high, low, and close. This is a dead end, decades in the making, 100% obsolete. Let me see if I can explain why. Here is our E-mini chart with the open, high, low, and close. What if instead of this, I showed you this? And what if I told you that these three bars represent the volume that traded at those three prices? And then what if I told you that it's also the largest concentration of volume in the entire engulfing period? Oh, and here's the close. That means that if the next period opens on a downtick, any new trade is going to be coming in below the majority of recent traders. Okay, does that sound bullish to you? And then what if instead of worrying about all the little open, high, low, and close data points in the other periods, what if instead I just told you that these prices are the largest concentration of volume in that initial decline? Would that data start to paint a more realistic picture of sentiment instead of highs and lows and opens and closes? Does the volume data do a better job showing where support and resistance might fall? Can we start to understand why a trading range was formed instead of a breakout? Let's look back at the gold chart. So here's our classic chart data on the left, and on the right we can see the prices where the largest concentration of volume occurred in the breakout. And when we move forward, we can see the concentration prices of the 4 previous periods. Right? So volume is stair-stepping up with price staying above it, creating support for the move higher. So is there more to a chart than the open, high, low, and close? You bet there is. Right? We have one chart that's bound by volume, and the other one is expanding while being supported by volume. And I realize that volume profiling is not totally new to the charting world, but the general premise is that by profiling weeks or days or the session, you'll find normal distributions, high and low volume nodes, value areas. That's all really valuable stuff. But with all this data that's being pushed to us from Chicago and New York and London and Frankfurt, why are we still building charts and designing trading strategies with periods made up of 4 data points, which in the grand scheme of things are totally arbitrary anyways? Okay, so think about how bizarre it actually is to argue that sentiment is bullish simply because after 5 minutes or 15 minutes or 1,000 ticks or 25 Rinko bricks, whatever your time scale is, simply because the last traded price is higher than it was prior. That's not an argument. We trade in markets that go up and down in price in a matter of milliseconds. If we have no record of the trade beyond the price, we're only playing with half a deck of cards. So at OFA, we see charts differently. We toggle them open and reveal what really makes the market tick. Volume. My position for the last decade has been this. If you're trading from a chart made up of only open, high, low, and close data, you might as well be driving a car with a blindfold on. We don't trade from just 4 data points. At OFA, there are 7 fundamental chart elements. The first one is the bid and the ask volume price. So this is the time and sales data that allows us to plot volume as sellers trading down into buyers or buyers lifting up into sellers. Those volume records for each price, they should be recorded and accessible for hundreds of potential calculations and indicators. Then we have the point of control, which is the single price at which the most volume in a period has been traded. I marked it in yellow on the screen here. Much more critical than the point of control is the volume cluster. Okay? This is a sequence of 2 to 4 prices that holds the largest concentration of volume. Okay, so notice in this case, the point of control is not even part of the volume cluster, right? A series of prices with a high concentration is much more critical to see than just one single outlier. We're going to be spending some time on this particular one today, so we'll get through it. Then we have the value area high and the value area low. These prices define a range that contains 70% of all the volume traded in the period. So think of it as the big brother to the volume cluster. And of course, the volume weighted average price. It is exactly what its name suggests. A mean value based on traded volume as an exponent to each price in the average. This is probably the second most crucial element behind the volume cluster. I have it marked here in pink. And finally, bid and ask ratio sequences. It's pretty common for people to get lost quickly when we start talking about the volume numbers inside of the periods. They can seem overwhelming if it's something that you're not used to seeing. I'm going to tell you that the applications for this data are endless. Okay, it's something that you really should take the time to get familiar with. But over the years, we've seen so many companies pop up overnight with some variation of the work that we've done. So to keep things simple and our IP protected, we're really just going to be looking at the sequences of imbalance between the volume. So in this case, the larger bold white volume on the offer is substantially larger than corresponding bid trade on the other side. When we see a series of these, we create what's called a map, which I'll show you a bit later. And this allows us to step back from all those little numbers and keep the chart a little cleaner for those who are easily overwhelmed. So those are the primary elements to an OFA chart period: the bid and ask volume, the point of control, the cluster, the value area, the VWAP, and the print sequence maps. Oh, and we also have the open, high, low, and close. So now that we have some new things to look at, let's go back to the start. But instead of starting with sentiment, let's start with volume sentiment. So first up, VCA, volume cluster analysis. As I said, this is 2 to 4 consecutive prices in a period that hold the largest concentration of volume, like a mini value area. Okay. To illustrate the importance of this, I'm going to use another questionable candlestick pattern. On the left, you should see a bullish Harmony pattern. Okay. In candle terms, this is a large down period followed by a smaller period higher, meaning first there's a close lower than the open, then a close higher than the next open, but not as high as the first open. You guys lost yet? Well, thank God for red and green, right? So the logic of this pattern is supposed to be a change in sentiment, all right? Basically, you have a strong move down that's indicating momentum lower. but that momentum fails to continue, and therefore a reversal or a bullish move might be coming, right? The key words there, might be, right? Okay, well, here is a chart of candles where we've added the volume clusters for each period in shades of orange. These clusters are going to completely change the dynamic of this. We dig into it. Let's take a look at the regular candles first. So here is the harmony. You can see it does a nice job of highlighting a reversal. Price moves down, we get a harmony. Then price moves up. Right. Nice. But what about here? Or here? Or here? I read somewhere that this pattern is about as common as canned vegetables in a grocery store. So clearly this is not something that we're going to jump up and down about. So let's go back to the volume cluster chart and see if we can make any sense of what's going on here. Okay, so the orange lines are the primary price in the cluster, and the light orange make up the other consecutive prices. Again, this is the highest concentration of volume in the period. Okay, so here is our harmony. So now let's track the sentiment or the position of the volume clusters on the way down. Okay, so first we drop a little moving into the red candle. Then the green candle of the harmony has the volume cluster even lower than that. And then the next cluster after the pattern is technically higher, but we can see that it's a move lower, so I don't think that's going to confirm a shift in sentiment for us. And then the next move is lower off the screen. Okay, so where is the next harmony pattern? Okay, right here, right? So where is the sentiment going in this one? Yeah, good job, James. It's still moving lower here, guys, and lower than that, right? So there's no change in sentiment. We have this great candle pattern, but that doesn't really mean anything. So now we're down at the third pattern, right? And it really doesn't look like we're getting any change in sentiment here. The clusters continue on the same path. And that happens until we get to the bottom, the one that we know worked, right? Isn't hindsight trading amazing? Okay, so what is different about this harmony? Right? Price drops lower through the clusters. And then suddenly we have our first sign that there's a change of sentiment. And it actually happens within the periods of the candle pattern, right? The move down has most of the volume at the low, and the move back up seems to be breaking away from volume at the lower middle section of the bar. And sure enough, we see the sentiment completely change direction and trade higher. So when you see these two candles with the volume clusters, you can actually make sense out of the concept behind the candle pattern, right? It begins to make sense why sometimes, under very special circumstances, a strong move lower followed by a smaller move back up, it might actually trigger a complete reversal. I mean, the candle pattern doesn't seem very logical to me to start with, right? It just seemed like one of those things that probably doesn't work very often. But if I go in and dig through it and figure out where the bulk of trade happens, suddenly I can see that there might be a chance that this could actually work. So let's recap, okay? With just the open, high, low, and close, we really have no idea what's going on here. Right? We can speculate about the sentiment, but there's no evidence to support it. Right? Whereas adding a way to visualize where the bulk of volume engaged those periods, well, now we start to see the periods kind of tell a story, right? And that story is going to make more and more sense as we move along today. So let's move over to the value area. Okay? This is a region of prices where 70% of all volume traded. Right? Classically, people think of a value area being over hours or days or weeks. But I'm going to show you how important this is over just a bar or two. So let's start with our old friend harmony again. Don't you just love that word, guys? You're all going to be hearing it in your sleep tonight. Harmony, harmony, harmony. So what is wrong with this harmony? The open, high, low, and close all tell us that it's bullish, but you guys now have X-ray vision, right? What is it telling us? Right. Good job, guys. Like to see the participation here. The volume cluster sentiment is bearish, right? It's still pointing down. So this is where a little volume profile analysis comes in handy. Right? By adding these two periods together with a simple drag and drop tool, we can see where the majority of volume traded in both the move down and back up. Okay? So what I'm getting at is that between these 2 points, 70% of the volume was struck. So what, right? So what, DB? What does that mean? Well, volume distributions can be a funny thing. All right, I can't go into a full VP class today, but I'll give you kind of the Cliff Notes version. Right? When price is trading within a volume distribution or a value area, the border prices are going to act as support and resistance. Price will often be bound inside the range, meaning it's not likely to go anywhere, which is not really something that we want to trade in, right? On the other hand, if price were to break below the value area low price would act as a natural level of resistance. And the opposite is true for any breakout above. The value area high price is going to act as support, indicating the value area is held by strong buyers unwilling to allow price to drop back into the distribution zone. So what this means is that sometimes our harmony is not going to get a volume cluster sentiment shift like that picture perfect example that I showed you a few minutes ago. And it might actually take another full period to see the cluster shift. And if that happens, what's to stop it from falling all the way back down? Well, hopefully the value area is there. Right? This is a great confirmation tool. By allowing the next period to form, we're generally deeper into the reversal, right? Which means a worse entry price and a larger stop if sentiment doesn't actually change. But by seeing price break above the volume, we create a barrier of support that we would never see with just open, high, low, and close charts. So let's dig back into some real charts. This is the ES again, this time from April 28th. We have a steep decline and we have that harmony at the low, right? But the reversal period doesn't confirm with a reversal in the cluster sentiment. The next period, it's not in our candle pattern, but we finally do get a shift in sentiment from the clusters. It's just a little late and 4 or 5 points off the low, which would mean a pretty big stop if we weren't using our amazing hindsight trading powers like we are right now. All right, so here's what it looks like when we add the value area prices to the periods. Right, in the real world, we would drag the mouse across this to include the periods in real time. Okay, but what we see is that the next period, it was able to break out of the value area high, confirming a much higher probability of seeing a continuation. Why? Well, because the upper value price, that should start to act as support, and that'll help us avoid any costly move back down to the lows. So here is a shot of the value area expanding along the way. You can see it continues to act as support for the move. And obviously, when we look at a live chart, you'll see how it moves automatically in real time. So just bear with me. And I want to be clear, this is not just a strategy for E-mini futures. Right? Earlier, we were looking at a gold chart, and here's a chart of Apple. Right? On the lower left, we see a low that's not confirmed by volume clusters. But there is a very clear breakout of the value area high price. And on the right, you can see how the value area holds support. Again, moving dynamically, tick by tick with the market. So we're going to do a quick pop quiz since you guys are participating so much. Here we have a move lower where the volume cluster of the last period shifts up to change sentiment. Is this a good confirmation of a reversal? No. Very good, guys. Most of you said no. Why? What's it missing? No breakout, right? No breakout of the upper value price. In fact, we have this volume cluster, that orange thing, it's just jammed right up against it, right? To me, this looks like there might actually be buyers trapped in a quick pullback and it's about to reverse, right? So we have a cluster shift, but no breakout to confirm it. Okay, so compare that to this version. Make sense now? Great. All right, one more question for extra credit. Do we have any candlestick aficionados here? Can anyone tell me what this pattern looks like? Imagine for a minute that you're only focused on the volume clusters. Forget about the green and red bodies. Just focus right here. What would that look like? Look at Sally. Good job. Right. A morning star pattern. Right. The clusters are really just forming the gaps. Right. In a candle body morning star pattern, you would have gaps. And what we're essentially saying is that who cares where the open and the close are? Think about where all the volume is. It's creating those gaps for you. So hopefully if you are a candle person, you are registering with that. So now we're going to start moving from concept and sentiment into an actual strategy. And to do that, we're going to need to add the VWAP, or the volume weighted average price. So let's assume for a minute that we saw this morning star pattern on a chart that we were trading. The value area breakout confirms the sentiment, right? The move takes off, and then the period finally closes. I'm happy now. Everything looks good. So I'm going to go long at the next open price. Well, now what? Well, there's really two things that I need, right? A target and a stop. But let's just focus on management for the time being. We'll get to targets in a minute. So it's been about, I don't know, 20 years since I went to a weekend seminar at a lousy hotel ballroom in Houston, Texas, and I paid some guy an insane amount of money to tell me that I should put my stop below the low, right? Below the low of the swing. Ouch. Yep, that makes for a pretty big stop, and I would like to go back in time and get my money back. As we've already seen, the low is just an arbitrary number, right? There's no real logic in saying that a move below the low is a good place to end my trade. So every time I have the opportunity to work with a trader and they're telling me about their strategy and why they put their stop below the low, I just kind of scratch my head and try and hold my tongue. But you're seeing it, right? There's a reality here. So I'm sitting here telling you that there is volume-based evidence on why we should go long here, right? There's support from a breakout. Doesn't it make sense to find a stop that complements that same logic instead of just saying, oh yeah, well that's great, but I'm going to go ahead and put my stop below the low? You really should think a little bit more about it if you're going to put all these pieces together. So let's add the VWAP. Okay, by the nature of being an average, it's always going to fall somewhere within the value area. Okay, so in this case, it's just below the value area price, the value area high price, I'm sorry. And this is a great spot to tuck a stop just below. Okay, and I'm sure somebody's going to ask, so I'll go ahead and address it. If the value area high is going to act as support, why would I not just put a stop below that price? Well, it's a very good question. Okay, and I'm sure somebody was just in the middle of typing it, so hopefully I beat you to it. Value areas increase rapidly with moves higher or lower. Okay, so once we have large amounts of volume trading higher, like the cluster that we see at the top, the value area is going to grow to include that in the 70% calculation, probably faster than you would ever be able to get a stop up there, and certainly it would probably take you out of the trade, right? But the VWAP is a very smooth average that will almost always rise or fall very gradually. Okay, which is one of the reasons it makes for a fantastic trailing stop level as well. And again, I want to state this as loud as I can. be sure to stay below it, okay? Never right on it, and we'll talk about why in just a few minutes. So for now, let's move on to a chart example, this time the Euro futures from April 30th. So we have our Morningstar sentiment shift here confirmed by a value area high breakout. Okay, so we're just going to throw this out there like it's a trade. Okay, we'll walk through a real trade in a minute, so don't get wrapped up in all the minutia. All right, let's assume that we just take a long at the 1186 open. All right, we've got all the pieces, everything came together for us. We're going to go long here. Right. Well, the VWAP is down at 1175, so trailing below it would be a 12-tick stop, right? And over time, we're going to see that there is a swing that develops. Right? And right in the middle of that swing, there is a pretty strong pullback and then a continuation. Any guesses what happens to fall exactly at the low of that pullback? That's right, Ralph. You're right on the money, right? The VWAP. Okay, and I'm sure that there is some magical Fibonacci pullback level that probably is exactly there too, but this isn't a Fibonacci class, so I'm going to press forward with my VWAP example, right? Because anytime that you have a substantial swing develop, you're always going to have mean reversion traders pushing back to take profit at the average. Okay, if you haven't heard that term, mean reversion trading, you need to go Google it. Okay? This is why you never want to have a stop directly equal to the VWAP, ever. It's almost always going to be hit, okay, and algorithmically hit. It will be slapped around. Somebody will make it their proverbial bitch, okay? It's going to be hit. And then, more times than not, we're going to see a continuation, okay? So in this case, after it gets tapped, we see a 50-plus tick breakout. Here's another chart. This is the SPDR ETF. There's a substantial swing higher, right? And price is driven back to the VWAP. Okay. And then a continuation follows. This is a perfect trailing stop for swing traders. If you are a swing trader, it's a perfect trailing stop mechanism. All right, but there's one thing that you've got to keep in mind. You've always got to monitor your risk to reward. A VWAP, it might be a very easy thing to tie a trailing stop to. A VWAP, it might be a very easy thing to tie a trailing stop to. But at some point, a real trend is going to advance closer to an upside target than the distance it would take to test the mean reversion. Okay? So you never want to risk a huge pullback when you have a close logical target. I'm going to show you a trade in just a minute where I really screw this up. Okay, so use it, but learn the limitations. Another great use for a VWAP is to use it as a target. You might say, well, how can it be a target and a stop? Well, I'm talking about opposing VWAPs. Okay, so here is a crude oil chart with price creating a massive swing lower. Okay, then it starts pushing back up. In this case, I'm using the tool to show me the VWAP and the value of the swing down instead of the swing up, which is what would give me a normal trailing stop for a long. Right? So when we look at this trade in replay, you'll see how I use two profiles to manage a target and a stop. Okay? But for now, just note that we can use a mean reversion from a prior range as a target and maybe even a previous value area high as well. Okay, the last element we're going to cover, this is the bid and ask ratio sequences. This is where we talked about mapping specific events in the print to generate custom indicators and alerts. This is not something that we can really learn in a few minutes, so I'm going to try to keep it simple. To do that, we have to start thinking logically about what the chart data is really telling us. So for example, we can assume that the volume cluster at the top was dominated by sellers who drove the market lower. Okay? And then they were followed by more sellers who were a little bit late to the party. And they were followed by more sellers who were so late that they ended up being trapped by the buyers who lifted price off the low. Consequently, at some point, those trapped sellers and late sellers need out of the market. Now, they may not want to buy, but they have to buy. What's that called? Come on, what's it called when you don't want to get out of a trade, but you have to get out of a trade? Yeah, don't make it any more complex than it is. It's called getting stopped out, guys. Right? It's called throwing in the towel, calling it quits. Right? It presents a tough situation on the chart. All right, because we want to assume that this is a reversal, and there's all kinds of buying momentum here, right? We see the volume cluster shift. We see the value area breakout. We're ready to use the VWAP as a stop. But what's the matter with this picture? Where did the buyers and all those orders trade the market up to? Yeah, right back into the original sellers, right? So we see some indications of strength here. I mean, we like our little pattern and we like all these things that are on the chart, and that's fantastic. So there's some good, but there's some trouble ahead too. All right. So the question, is there enough strength to overcome this previous selling cluster? And really, to figure that out, the only thing that we can do is open up the chart and look at the volume. This is where we start to look for patterns of imbalance, sequences where the trade into the offer, buyers trading into sellers, substantially outweighs the bid trade where sellers are fighting back. Okay, so you can see sequences like that here and here. The large white volume numbers, they've just been formatted on my chart to stand out when the buyers are showing strength. They could be any color I want. I just happen to have them white so that we can see them today. All right, and OFA can then take that information and allow me to build a custom indicator without any programming to show those sequences on my chart. Okay, I've basically converted the sequences of white volume numbers into little blue dots on my candles. So now I can see the strength confirmation I was looking for when we only traded back up to those previous sellers. Right? And we can see the other places on the chart where we have similar events, which can be helpful as well. So let's put it all together with a trade example, okay? I'm going to do a quick walkthrough of the trade video first because my experience doing this tells me that it's very easy to get lost. Right? Generally, you guys are focused on a question or something and not focused on what's happening, and I need you to keep in mind that I have to cram a 70-minute trade into a few minutes. So there's some editing, zooming, and such. So I want to kind of explain it first. First, you're going to see how I drag and drop the value area and the VWAP onto the section of the chart that I'm interested in trading from. So somebody earlier was asking if I'm using a regular trading hour VWAP or a session VWAP or a multi-day VWAP. I'm talking about I get to pick. I get to choose, right? I'm going to pick out what I want, and it's generally going to be the most logical swings or from where my trade began. Because let's face it, whatever's on a chart, whatever a 5-minute period is or a 50, who cares, right? The only thing that matters once I'm in a trade is the volume that comes in behind my trade. That's it. Nothing else matters. Okay, so specifically, I'll be profiling a large swing lower, and I'll be looking for a long to trade back up to the VWAP and eventually across the value area. Okay, the next thing that we'll see is how the volume cluster sentiment sets up the trade. Okay, I'm going to profile a couple of different setups before finding the right one. So you're going to see an example that it fails to confirm. So make sure you take a look at it. The actual trade is a long, which is confirmed by a value area high breakout, and the VWAP becomes the initial stop and then the trailing stop until at some point it's no longer a logical stop. And we're going to discuss that when it happens. The first target of the trade is the VWAP of the previous swing. Okay, so you're going to see two sets of lines on the chart. I'm profiling the previous range down to give me targets, and I'm profiling my trade higher so I can manage the stop. So try not to be overwhelmed. I'll do my best to walk you through it. And we're going to see a perfect mean reversion to the VWAP, okay, and how my stop is protected by it. Now, like a dum-dum, I really didn't use very good management at this point, so I'm going to make sure to talk about it. The trade works, and that's great, and you get a good example, but there's a lesson to be learned in hindsight, so I want to make sure and bring that up. And the trade is going to close by moving all the way up to the value area high of the previous swing, which in theory should be resistance and create a large range. Okay, and that's why it's smart to have targets instead of just a trailing stop and think, well, I'll just go up as long as I can possibly go up. All right, we ought to be able to look for the other side of the trade as well. So let's dive in. Oop, gotta get there sometime. All right, so you can see I am dragging and dropping to create the profile here. So all I did was I took the swing high to where I am currently, and now it's going to populate that moving forward. I'm trying to get this off of the screen, but it won't seem to go away. Don't know why. Okay, so we zoom in here, and this is a small area where I profiled, and you can see the intent was I thought I was going to have that kind of morning star setup, but as we discussed, the breakout never comes and it doesn't break through. So it's kind of, it's not an opportunity to trade, and that's the kind of thing that we have to pay attention to. So now I have another example where I've set it up, and you can see this one is kind of coming together, and this ends up actually being the trade execution here. So what we've got are cluster sentiment going down, but we're breaking out of the value area. Now we obviously have sentiment going up, and so there is my limit order to get in at the open of the next period, and I'm ready to move my stop and target accordingly if this ever gets filled. And again, you can see the strength there, the three little dots, my orders on top of it right now, but that is what's telling me, hey, go ahead and go for it, because all you really did was trade back up to the previous cluster. So I've got a little bit more evidence by seeing that. Okay, so there is the fill. So my target goes out to the VWAP. I've got another target up above that we'll deal with in a minute. And you can see the stop there. So the fill is 56.92. This is a crude oil trade. I should have said that from the beginning. 56.92 fill, 56.87 stop. So my stop is one tick behind the VWAP. And you can see the value area keeps expanding. So that's why I can't use the value area high as a stop, because right now it's above, I'd already be out of the trade, right? It's going to keep moving as more and more volume builds, which is really going to be critical. Okay, so now you can see the VWAP target up above, and we ought to be able to see some stop movement here. Looks like the stop is 56.90 now, so it's a two-tick stop. And the VWAP just moves, so the stop moves up, so up another tick. And up again, and the target moved as well. So it's kind of one of those things where everything's dynamic. As we start moving up, the other VWAP's going to start moving down. Here we are, we're about to tap into the first target at the VWAP from the range down. And there it goes right there. And you can see the other target is up above, up at the value area high. So this is where I said it gets a little bit confusing, because I've got two different profiles going on. But what we're essentially doing right now is coming back and testing the VWAP, right? We're trading back into it, and that's why it's so important to have your stop on the other side. Now I'm going to pause this real quick, because I told you that I made a very, very crucial mistake here. And it may not be easy for everyone to see. Let me see if I can drag into this a little bit. Okay, so my stop is down here at 57.14. Okay, and I'm just going to assume that when we were back here, my stop wasn't at 57.14. It was probably significantly lower than that because we obviously have a bunch of volume that printed up here, but I know it wasn't too terribly much lower. My target is 57.49. It may have been a couple of ticks higher as well. Okay, so let's just pick a number and say 39, since we traded up to 39 here. So in theory, I had a target that was 10 ticks away, and I allowed my trade to come back 10, 20, maybe 25 ticks. That's not good management, is it? Does that make sense, guys? Yeah, it's not good management. I mean, why am I risking 25 ticks to make an extra 10 when I'm already in a profitable trade, right? And that's just one of the things that you have to be cautious with, because a VWAP is going to give you a very wide stop, a very wide trailing stop, which is excellent for swing trades, but they need to be in context of some sort of target, right? If you're looking to get somewhere, and you're fairly close to it, allowing it to come back against you that much is probably not brilliant, right? Now, in my case, hey, it worked out, and that's all good and well. But anytime I see an example that has some flaws to it, I want to let you know. So you can see here what I've done is I moved my stop up away from the VWAP. It's like, okay, it doesn't even make any sense anymore because here we are up. So I'm going to go ahead and close out this profile. Then what I'm going to do is start profiling the nearest swing. Look at that. I ended up having my stop in the right place. It was just dumb luck. The new VWAP is at 32. My stop's at 31. Right? So it's something that you can do every time you've got another swing. It's something that you can readjust so that you're making a reasonable adjustment with your stop, as opposed to just saying, oh, well, it's tied to this and this is as far as it's going to go, because that's kind of not really a very smart way to trade. All right, and there is the trade closed out. So if we back up and look at this, what you'll see is that we had a nice entry off of all the tools that we just talked about, this whole presentation, right? We have everything that, putting all those pieces together, using the value area and the VWAP and all of those things to get long down at 56.92. We trade up to the VWAP at 57.62, and then we trade across to the other side of the value range at 57.49. So hopefully that puts a lot of these things together. Okay, I think we need to do probably just a very quick review. I think that'll help, because I'm seeing some questions. People are lost, and I understand there's a lot of new concepts here. So I apologize if I'm moving fast, but I only have so much time. Okay, so the first thing that we ought to just state plain and simple is, if you want a chart with real purpose, and I don't mean the noun, if you want a chart with purpose, I mean if you want to chart, the verb, with real purpose, you've got to get beyond price data. Okay, volume is the record of trade. It tells infinitely more than price ever will. Okay, so your objective should be to follow the sentiment by finding the volume that's controlling support, resistance, strength, weakness, whatever it might be. Now, early on, we looked at a gold futures chart. Okay, this was the engulfing candle. And the lesson to be learned there is that every breakout must be profiled before you jump in it. If you have trapped buyers at a high or trapped sellers at a low, it's probably going to pull back and create a range, not the momentum that you're looking for. Then we had the E-mini harmony. Cluster sentiment is the key to catching reversals early. You can't trust the harmony if all you have is price data, or any candlestick pattern for that matter. You add volume clusters to it, and now you have a logical approach to leading the sentiment. The S&P and Apple charts gave us a way to confirm reversals that didn't have clusters lining up in the first two periods. Right? They're not all going to be perfect, but if you add the value area, you know where the bulk of trade is positioned, and you also know when a breakout occurs. And with the Euro and Spider ETFs, we introduced the concept of a VWAP-based trailing stop. We saw how mean reversion strategies create pullbacks that clobber trailing stops as they attack the VWAP. Right? If you're a swing trader and you don't know the VWAP of your swing, I fear for you. And finally, with crude, we put all these pieces together. Right? We used a prior swing lower to give us targets for a long, and we even learned a lesson about monitoring risk to reward while trailing up to a target. So that, my friends, is the end, almost. Before we go, I want to tell you a little bit about who we are and what we do. OFA stands for Order Flow Analytics, and this is our 8th year in business. Our approach has always been three-pronged. Everything we do is built on technology, education, and experience. On the technology side, we have OFA Ninja, which is much more than just a charting add-on. We live in a faceless world of Amazon and iTunes, and sometimes we forget that there are actually people running a company. And at OFA, we have faces. Okay, that's me there on the left. I personally design every concept that we put into our technology. This is not some script that was written by a weekend warrior who likes to tinker around with Ninja script tools, right? This is not that. We have a professional development team that they're the ones that built the technology systems for the National Stock Exchange in India. Okay? Our algo team in Chicago, they're the firm that companies like Citadel and Getco hire when they need consultants on exchange compliance. This is our domain, right? We pioneered order flow analysis, and I realize that it's a great buzzword right now. I see it on every marketing email and webinar invite that I get. But there's a huge difference in working with OFA and the overnight gurus that claim to be experts. Our clients are amazed when I reply to a support ticket. That's me. I have to. I need to know what's going on with the application. I can't outsource that. George, he'll pick up the phone and we'll talk to you for hours about the highs and lows of your trading career. I realize that everything is supposed to be an automated campaign these days, but you need to know that we're not just some guy with an indicator, right? We're the company that's changing the way people think in this industry. On the education side, we have Mark. Mark's a guy who walked away from a top-tier position at one of the largest health insurance companies in the world to be a full-time trader. He teaches a class for us called Beat the Market. It's a live class, real class where you can ask questions and do homework and participate in the discussion. This isn't the 10 DVD do-it-yourself version, right? We hold the class quarterly so that students can always come back for free and learn the most up-to-date content, strategies, and trading tactics. Experience. Some people need more than a class. They need the experience of a mentor. This is where Chip comes in. Chip is a professional bond trader. He trades the Treasury futures, 30-year, 10-year, and 5-year, as well as some indexes. His objective is to get you qualified to earn a funded account. It's a 90-day program, and you can trade right along with him every Tuesday, Wednesday, and Thursday of the week. This is who we are and what we do. Now, please understand, I'm not a used car salesman, and I hate dangling discounts and deadlines over people. It just drives me crazy. But Trade Like a Pro is a special event we only do one time a year. And so we've put together a bundle of everything we have and everything we do, and we're going to extend a $1,000 discount to everyone participating in this webinar. Okay? Here is the website that will give you all the details. But please remember that there are people behind that website. This is not meant to be some sales pitch. If you need to speak with someone and get your questions answered, we're a phone call away. All right, my goal today was to show you the value behind the chart, not to force you to make some spontaneous purchase. Take your time, visit some of our previous presentations on YouTube, inform yourself so that you can make an informed decision. I'd like to thank NinjaTrader for having me back to present again. We look forward to NT8, and hopefully we'll get to squeeze in another presentation in the fall. Let me dig into some questions now. Do I still trade oil? This was a oil trade from just a couple of days ago, Sammy, that I took. Does this run on NT8? We don't have the NT8 specs yet, but we will obviously move it into NT8 when it's here. The webinar is recorded. Spoofing. Does spoofing affect your service? That's a big word now these days after they brilliantly blamed one guy in his underwear in a basement for breaking the market. What we're tracking are actual trades that are struck. So spoofing doesn't have any effect on what we do. We're talking about trades that are actually struck. Spoofing is adding orders to the queue and pulling them out before they are filled. Jason asks, are these aggressive buyers and sellers? Yeah, it's one way to put it. I mean, that's kind of the terminology that's been passed around over the last few years is that they're aggressive. That's not really a very logical way to look at it. I guess it's kind of misleading. But the idea is that if you have somebody attacking the bid with a market order and there is a buyer there with a limit order to buy, the seller that's attacking the bid, I guess, is theoretically aggressive. What they really are the one who's conceding. And that concession doesn't necessarily make them aggressive, but it's what drives the market price up and down. Link is not working. I don't know what to tell you. I was there earlier. Link is not working. I don't know what to tell you. I was there earlier. I hope it's working. Orderflowanalytics.com/NT special. Well, that's always good when you have a page that doesn't come up. Oh, it seems to be working for some people. Spotty, huh? Yeah. Thanks for trying to repost. Question about Forex. Yes, you can use this in Forex. Forex obviously doesn't have volume in the same manner that stocks and futures have volume, only in the sense that that it's not a fixed. You know, when you buy a share of stock, it's one share of stock. When you buy a contract of futures, it's one contract. When you trade currencies, you're trading, you know, a trade for some denomination. And so volume doesn't really work the same way, but it sort of does in the sense that you can see strike prices. So when you see those strike prices, you know that a trade occurred. It's just you don't really know what the size is. So the simple answer is yes, but it does not. It doesn't reflect the same way as, say, the example that I had with the Euro futures up is a little bit more. It's obviously going to be more accurate because we can technically track the volume that was traded. What charts am I using if I'm not using candlesticks? These are our own custom charts, right? So we built a custom chart format for NinjaTrader. So they look a little bit like candles, but there's obviously a lot more to it. We want to make sure that those 7 key elements that I talked about are there, in addition to obviously the open, high, low, and close. Okay, www, sorry. Yeah, there's a great question here, and unfortunately they're coming through so fast I'm trying to scroll up and stop it. So there's a great question here. If I can get to it, I will. I got all these little question boxes on here. Marlene asks, very often this type of technology or software is used to trade bonds or the ES, i.e. high volume, highly liquid markets. However, does this work well for light volume contracts with gaps like wheat and corn markets, please? Even worse on the Euronext, 10 times less volume than on the CME. I will tell you that I personally have several clients that trade corn and wheat with OFA. I generally do not trade a lot of hard commodities. I generally don't for the reasons that you're talking about. However, I spent a lot of time last year going through and looking at the relationship of the order flow prints in soybeans and even in cattle, which really only has one quick spike move. So the simple answer is yes, but as I said, what you're trying to accomplish is generally a little bit different because of the, you don't have these incredibly thick moves that build up a tremendous amount of volume. You've kind of got to look at it over a larger time horizon. Yeah, a bunch of questions about education stuff. If you dig through the on the website, you'll see exactly what comes with all of the education. It's pretty comprehensive. The idea is Mark likes to teach from the position that you have a software tool, but then you have to understand the market context and what that tool is trying to accomplish. So if you notice the way that I taught today's class, and I hope that you guys felt that this was a class and not just a sales pitch, because I spend a lot of time doing this. So hopefully it was good information. But what I want to do and what Mark wants to do is take you on a journey from two different points, point A to hopefully to Z. And in order to do that, you need to understand not only the idea that there is, this piece of technology, but where that can be applied in a manner that that shows you some sort of logic to what you're seeing in the market, right? Because otherwise, I might as well just say, I got this black box, and you turn it on, and then we're all going to go drink beers on the beach, right? Because you don't need to know anything that happens or why anything happens, or God forbid, if anything went wrong, what you would do about it, right? That's not the case. Instead, you really need to understand. It's funny. I know I don't have a lot of time, so Wesley, I'll try not to bumble on too long. But I was at the Chicago Board of Trade a couple of weeks ago, meeting with a group there, and I was talking to a trader who was really digging into the idea of order flow. He just said, "Gosh, I'm appalled at what I was taught going through a quantitative finance degree." He was really appalled at the quality of information when it came to actual trading information and specifically what we call market microstructure. So it's something you can Google or look on Amazon. It'll be the difference between getting a book by Wiley that costs $50 so that you can read about some guy's theoretical trading career that probably never happened, and a real book that's like a college textbook. So get a book on market microstructure. And what you'll see is that the college level university still to this day is treating markets as though they were 50 years ago, right? The markets are very efficient and this, that, and the other. And we all know that with high frequency trading and everything that we do now, markets aren't efficient, right? There's a huge gap between what people are being taught and what people actually learn from experience in the marketplace. And I believe that Mark does a very good job of connecting a lot of dots between the primary theories of things and then the practical application of it, which is something that is very much missing in most trading education out there. And I don't just mean from the guys who sell courses online. I'm talking about all the way around. Indian customers trading Indian markets. Chris, good question. I don't know the answer to that, to be honest with you. My development team's in India. I can certainly talk to them and have them test through, but I don't know what. Maybe I need to look at the data connectivity. I'm not sure with the data providers that NinjaTrader has if they have Indian access or not. Clearly, if you have data coming through NinjaTrader for whatever market you're talking about, then obviously we can apply it. Marlene, NinjaTrader always does a great job of sending out a recorded version of the presentation the next day. So either tomorrow or the next day. So I imagine you'll get it in your inbox, and we'll probably put a version on YouTube sometime tonight. So if there's something you want to go back and review. Okay, so there was another question about the volume weighted average price, and could I talk briefly to that? As I said, the principle and the way that I presented it today is that it's a technically, I mean, it is what it's called. It's a volume weighted average price. So there's an exponent of volume that changes the mean price structure, and you're always going to have trading systems that are designed specifically to revert back to the mean, to trade back to them in a momentum phase. So so it becomes something that if you are not aware of what the volume weighted average price is, and it doesn't matter if we're talking about over the course of a day, or if we're talking about, like I used in my example, just over a few periods, it doesn't make any difference. And I'll just tell you from my own experience, when I go to Chicago and I'm at the Board of Trade, there aren't a lot of people who are sitting down with and trading in the manner that most people here are thinking about trading, with charts and whatnot. Generally, prices are set, and volume weighted averages are applied. So once a price level is triggered and we start to decline, machines are triggering trades into the volume weighted average price, not necessarily from the day, but from any particular swing. So it becomes a very useful tool as a trailing stop mechanism. Yes, Marlene, the answer is yes. I have done extensive work on looking at multiple days of thinner instruments. So just, you have to widen the time horizon. The question is a VWAP useful as an entry point? It certainly can be. You've seen how price rejects the VWAP very often. It can be. I've seen some books to the effect that people say instead of a mean reversion strategy, you should be trading from the mean. I've never looked at it that way. To me, it's always been a target principle, because you're generally going to have the momentum of the machines with you as price approaches it. So whenever you get very close to it, you'll see that price moves very, very rapidly into it, much more so than the response off of it. Gosh. Guys, I want you to know your questions are very important to me, and I'm not trying to skip anybody. They're going up my screen so fast that I can't. Sometimes I'm start reading one and I can't see it. So if for some reason I don't answer your question, please, submit it to us. I'll do my best to address it. Brian's asking about time-based bars, and Brian, we actually have our own way of building bars. We don't use traditional time bars. We use bars that are based on what we call probes and rotations. So if you want to hit our website in the tutorial section, there's a whole section about probes and rotations. It's probably a 3-minute video that would explain it. But the premise is that when you're reading order flow, it doesn't do you very much good to look at volume that has gone over price, over price, over price, over price, over price. It just doesn't make a lot of sense. So we're looking for directional moves so that we can actually read the print, which is the way that it's been designed. So a lot of people want to see like a vast amount of data as opposed to what I was looking at in a very short term. And so it just requires loading a larger probe and rotation, so to speak. S&P using a pit volume as well as the electronic volume. In the E-mini S&P, Bob, there is electronic volume. By the nature of the contract, it is an electronic contract. So it's very difficult to scroll up. Lots of time frame questions. Yeah, so Marlene, is it Marlene that kept asking about the? Yeah, you'll notice when you see the order flow over a gap, how you know how misleading a real candle is, because you see a candle that reports price, but of course, 20 of the prices in that candle didn't have any volume that traded at it. It's technically a gap, but the way that price charts are designed, unless there's a close, you don't get to see that gap. So that's one of the, I was talking to somebody recently about the flash crash day back in 2010 and how much fun it was to trade that day, because if you're looking at the volume instead of the price, you could see where trades were actually coming into the market, and so you knew there'd be liquidity there. If you weren't looking at the volume, it looked like total chaos. It was quite a lot of fun. Okay, well, I've taken up more than an hour of your time today. I sincerely appreciate you guys for stopping in. I hope that it was useful. I know it was a lot of information, so if you need to watch it again, I totally understand. We'll make sure that it's posted. But thank you very much for taking a little bit of time out of your day to spend it with me. And I look forward to talking with you guys in the future. And Wesley, thanks again to NinjaTrader for letting me do this again.
All right, and a special thank you to you, DB, for sharing your 7 steps to success, as well as some truly wonderful trading insights for everyone here in the room. I'll go ahead and post that special offer link in the room for everyone one more time here, in case you did miss that. And then also, if you did show up late for today's event, don't worry, we have recorded this webinar. We will be emailing you with a copy of that recording, how you can go ahead and take advantage of that. Once more, I'd like to give just a special thank you to DB, the rest of the team over there at Order Flow Analytics, for the great presentation and for offering our NinjaTrader ecosystem family a very special discount. Thanks again to everyone attending today. Enjoy the remainder of your week, and as always, happy trading from all of us here at NinjaTrader Ecosystem.